How do you get it spying on other departments?
Wouldn't you just give them some wouldn't that do the job?
Okay, so I'm going to get started for the 6 people that showed up. Now I'll know better than to send an email. I'll just not show up and I'll send an email to one of you guys and go. And if I'm not here by 10:10, just tell them that I let you go. So I'm going to continue with going through dividend policy stuff. But before I do, what questions do you guys have? Since there's only 6 of you, I can tailor this class essentially, although I'm recording it, I can tailor the class to anything you guys feel like you need help in.
Question.
Yes, sir.
So obviously, this class is geared towards the investor that wants to make money, right? Obviously. But well, how would, let's say, a nonprofit try to, how do you spin that?
From a finance perspective?
Yes.
Okay, so generally, you're correct in that when we look at things here, we're focused on markets, market conditions, cost of capital, cost of equity, those kind of things. You go, how do we deal with that in a not-for-profit world? You've got really 2 components in a not-for-profit which are different. One is your equity piece. So your equity piece, essentially, in a not-for-profit, is driven by surpluses. So you retain surpluses within the organization. And the decisioning isn't driven around hurdle rates as much as it is the mission of the not-for-profit and the desires of the donor. So for instance, when you're looking at a university, in a university setting like we have here, university needs to have some level of reserves associated with being able to withstand ups and downs in enrollment or spiking prices. And here's one of the challenges. So you look at it the same way in that what's our risk, what's our operational risk, what's our operational leverage, what's our financial leverage. We have bonds which are publicly traded, which help set us a market rate for our debt, which again, if you go back to some of those rules of thumb, you could add 3 or 4 percentage points on and come up with a required return on equity. So you can actually use most of these tools by using rules of thumb. Having said that, you look at schools like ours, for instance, we're setting tuition in May for 2019-2020. I don't know what's going to happen between now and September of 2019 when folks actually start paying their tuition. We could see prices go up, we could see prices go down, we could see wage inflation, wage deflation, we could be in the middle of a financial crisis. I don't really know. So we have to set, by federal law, we have to set tuition out at least 18 months ahead because folks can submit their FAFSAs on prior year taxes and get awarded financial aid almost 2 years out. So we'll be awarding financial aid in September, October for students that are going to enroll in May if you decided for early admission and wanted an early decision and early financial aid. So we have to set things like what's our operational risk, what's our operational leverage, and then have to kind of determine what the surplus needs to be able to support that. And that's done in conjunction with the board of trustees. So a lot of what we deal with in finance, even though we're looking at it here from a for-profit perspective, which most of us will end up working in a for-profit environment. Those that work in a not-for-profit environment, you have many of the same challenges, and in some cases even more because it's tough to go to the market. I mean, you can't sell part of your not-for-profit. It's tougher to merge them, although it happens. So again, we use things like rules of thumb to go, okay, what's the equity that we need to have? In our case, we're at about 8 to 8.5% is our cost of equity, which is what I use, a 10% number, 12% number. I give us a little bit more of a boost because our operating leverage is very high here. Fixed costs are high. We have 100 students, or we have 1,000 students at St. Martin's. We have the same number of buildings. I can't scale them. Most of our faculty is tenured. 60% of the faculty is tenured, which means they can't get fired except for cause, and that cause needs to go through a process which takes almost a year of trials and other things to get them out.
Say you want to fire people?
No, No. But if you're in a for-profit world without tenure or a non-union environment, and if your business goes down, you do layoffs. Here at a university, I can't lay off tenured professors. They're a fixed cost, essentially. The buildings are a fixed cost, and they need to be heated, and they need to be cooled, and they need to be maintained. And so one of the challenges for higher education, so a not-for-profit like this, which is very facilities intensive or resources intensive, is as enrollment goes up and down, the costs stay almost the same. So when enrollment is high, which it's been the last couple of years and it's continued to grow, the university has a little bit of extra money that it's able to fix stuff and, add programs and improve scholarships and those kind of things. When enrollment goes down, bless you, when enrollment goes down, we can't do that. So you end up in a situation where all of a sudden fixed costs are fixed. And 2 years ago, the university lost almost $3 million because we had very small freshman sophomore class, which is now our graduating senior class and junior class, were very small. And so you had declined enrollment on relatively small enrollment base. And we couldn't shut anything down. You can't get rid of the CFO, you can't get rid of the president, you can't get rid, so the costs remain the same. And so as a result, the university lost money. Last year, big incoming freshman class, decent class the year before that, fall of this year, fall of last year, fall of the year before, we've been over 200 incoming freshmen plus about 150 transfers. We made $6 million last year. But much of that was gains in the market, and to the extent there was cash, it gets set aside because at some point enrollment will decline again, and it has over the last 124 years. We've been able to see it go up and down. It trends up, but you have these blips, and when we have a blip, we need to have reserves to be able to cover it because our operating leverage is so high. So our risk is relatively high. So when I look at things, I go, okay, what's the beta, or what's the risk profile? The rule of thumb says, well, you take your bond, you add 4%, that should give you a cost of equity. And I take that at 8% and say, we really should be somewhere between 10 and 12 for the equity side. So when we're deciding whether to build a dorm or whether to add a program, the hurdle rate that I tend to use is a 12% hurdle rate. So all the skills and stuff that you use here, or that we're learning here, you can apply in an operating world. It's just a little bit more challenging to get that risk piece. The cash flows are the cash flows are the cash flows. And since finance is cash flows and risk, and how do the two interact, and that's your discount rate, really the tough thing for a not-for-profit is how do you figure out what that discount rate needs to be in a hurdle rate, and you use some of the rules of thumb that we had earlier in the semester, and it's somewhat subjective. So for here, I run it a little bit higher. If I was at my alma mater, which has a $21 billion endowment, I'd probably run a little bit lower. So because the risk is a lot lower, even though they have some of the same operational challenges, they have more financial flexibility. What other questions? Yes, ma'am.
So what Excel sheets are we need?
If I were a betting man, if I could look into the future and see what the final looked like, I would have an Excel spreadsheet that helped you calculate weighted average cost of capital. I would have an Excel spreadsheet that helped you do capital budgeting. And you may want an Excel spreadsheet that does theoretical stock and bond price. But the two I would absolutely positively have ready to go is one that does weighted average cost of capital, and I would have one that does capital budgeting and set up and ready to go. Now that doesn't mean that you're not going to have to add periods, but that you're going to have to make some changes, and some you could have operating cash flows that you need to calculate because you've got things like depreciation and amortization, non-cash costs, and tax effect, or maybe no tax effect. So some of the elements may or may not be in there, and you're going to need to know which pieces to pull out and stick into the equations. But that's what I would be looking at from an Excel spreadsheet perspective. And then the third one, like I said, is a maybe, depending on how long it takes me to finish the final this weekend, which is when I take it, which is whether you have a theoretical stock or bond price one. Again, some of that will go into weighted average cost of capital as well. The one thing that I'll give you a heads up on, which is somewhat important, you may see it, is how do you think you deal with a company where it's got 3 different preferred stocks issued? So it's got a preferred stock issued, par value of 100 with a dividend at 9%, par value of 100 with a dividend of 7%, par value of 100 with a dividend of 10%. How do you think you handle that?
Which one was issued first?
No. Good guess.
Highest percentage first.
Not quite, but you're on the right track. If you have a situation where you've got either debt or preferred stock where you've got multiple types, so you've got preferred stock A, preferred stock B, preferred stock C. They have different risk profiles because they're going to have essentially a preference of liquidation, which likely is the first one issued as preference, then the next one would be subordinate to it, then the next one would be subordinate to it. We're going to have different costs. So in order to do a weighted average cost of capital, you either need to take each one of those separately in the weighted average cost of capital, or you have to come up with a weighted average cost of preferred stock and factor that into your weighted average cost of capital. Or, and this is an example that was actually on the final 2 years ago, or a year ago, was you had to come up with a WACD, the weighted average cost of debt. And essentially what you had was you had bank loan or a line of credit at a cost of 2%. You had a bank loan with a cost of 4%, and you had subordinated bonds with a cost of 7%. So your weighted average cost of debt was actually taking each of those components, figuring out what the cost of that debt was, and coming up with a blended weighted average of the cost of debt, then feeding that into your cost of capital, assuming that you're going to continue to keep that same ratio of, and that was assuming you keep the same ratio of line of credit, bank debt, and subordinated notes. And so just if you see something on the final where it's got multiple types of the same, normally it's either going to be preferred stock or debt, remember to do the weighted average of that piece before you put it into the weighted average cost of capital. Because what is typical for a company is not that it has, and, we've kind of seen that here. The book says, well, the cost of debt is X. In reality, most companies have multiple types of debt. They have bank lines, bank notes, subordinated, mortgage. They've got 4, 5, 6 different types of debt, each one with a different cost. And so if you're assuming that you're going to be maintaining the same ratios of those types of debt, you have to go up with the weighted average cost of debt, which is called a WACD, WACD, weighted average cost of debt, and that then feeds into your weighted average cost of capital. So on the final, I would make sure I've got the weighted average cost of capital. I would make sure I've got capital budgeting problem set up where you could do the operating cash flows, which would include things like depreciation and tax effect. And then I would also be thinking about if you see something with multiple types of either preferred stock or debt, that you need to figure out the weighted average cost of that to then feed into the weighted average cost of capital. What other questions? No? You guys are getting like the super top secret, here's what's going to be on the final exam, right ahead of the final
Can we
exam.
walk through one of them that you just talked about? Or
We're going, so I'm going to walk through weighted average cost of capital and a capital budgeting problem the last week of class. Yes, I'll do that. That's pretty straightforward. For those of you who have been setting appointments with me, there's a couple of you, I think, in the class. We've been walking, the folks who've been doing that, I'm basically taking them through old finals. And the one old final that I've been taking through has that. So you'll see it. But at the end of the day, what you're gonna end up with on the final right now is likely to be 20 multiple choice questions and 2 problems for 2 hours. It's taking me about 40 minutes to complete. It's taking me about 30 minutes to complete if I've got the spreadsheets already set up. So in 2 hours, you should be okay. And then the question's going to be on the multiple choices. They're not math problems. They're things like, for example, finance is
Yeah.
related to, and then multiple choice,
Future cash flow.
future cash flows. And yes.
I just had that on one of my quizzes.
did you?
Yeah.
Okay. So yes, that's exactly what you'll see stuff like that. And then you'll see, or very easy, here's X, Y, and Z. Pick one that is, for instance, cost of capital. And then you've got 2 work through it problems. The 2 work through it problems will be codependent. So you essentially will have question 1 will then feed question 2. So if you think about it this way to tie stuff together, you'll probably be asked to calculate a weighted average cost of capital, which is then used as your discount rate for your capital budgeting problem. So if you've got one thing to really focus on, weighted average cost of capital it's pretty straightforward stuff. But we'll see how complex I get the inputs, whether I give you all the inputs or whether you have to find. Yeah, you're looking for.
Give it.
Yeah, we'll see.
Come on.
We'll see. I want to make it actually useful, so that you learn some skills. What other questions? Any other questions?
So, this school, like, it seems like it's very volatile, like, bad year, then it goes into different. Is that why tuition is being expensive?
Yes and no. So the average tuition, the actual tuition paid by a student here, depending on the program, is pretty competitive. But so very few students pay the full tuition rate. Most students have a combination of merit aid, need-based aid, other institutional aid, and our average collected tuition is around $14,000 a student. And that includes, of course, you got Benedictine scholars, you get, on top of all that, you get a $10,000 a year additional award. You've got Abbott scholars, you get full free tuition, you've got athletic scholarships, you've got, all those things get factored in. But on a rack rate, we're on a stated tuition amount of about $36,000. Most students pay about $20,000 less than that. And then add on room and board, and that, brings the number back up. And some students are paying that full amount. It really depends on a combination of expected family contribution and what their grades were coming out of high school. And in some cases, like in business classes, engineering classes, nursing classes, you get to pay the tuition surcharge.
Yeah, why? What is that about?
So that's a good question. For faculty in business, engineering, and nursing, the faculty are paid significantly more than those in College of Education or Arts and Sciences outside nursing. Because, again, when you think about the type of professors we have here, almost all the business professors, I think all but one, have doctorate degrees. You've got in the engineering school, they've all got doctorate degrees. Our computer scientists all have doctorate degrees. They're almost all. So what ends up happening is those folks, especially when you're thinking about accounting, finance, computer science, they can make a lot more elsewhere. So to pay competitively, we have to have the pay for those professors is significantly higher. And so that's where the tuition surcharge comes in. A lot of schools, if you look at Seattle U, for instance, you go to their website, you'll see that they have differential tuition. So essentially, instead of a surcharge, so we go, our tuition is $37,000 a year, and then if you take a business class, it's an extra, $65 per credit hour. At Seattle U, they go, if you're taking an engineering class, you're going to pay $1,450 a credit hour. If you're taking a business class, it's $1,300 a credit hour. If you're taking theology, it's $750 a credit hour. And so they do it that way. For us, it's a lot. Our systems aren't quite as sophisticated as CLU, so it's easier for us to do it by surcharge. But it's a pretty common model for those kind of things. And essentially, the other side of it is when you graduate with a business degree, when you graduate with a engineering degree or computer science degree or nursing degree, you're generally going to have an easier time getting a job at a higher rate of pay than if you graduate with a degree in English or psychology or education, where the pay tends to be a little bit lower. So that's the other side of it is professors cost more. On the backside, the ROI should be equivalent because you should be getting paid more as well. What other questions? These are good questions.
Those are like really popular degrees, so I'm sure a lot of people fall into that trap.
It's not a trap.
It is a trap.
No, it's not. Our most popular, our largest major is biology. So biology is the largest major at the school. They don't have tuition surcharges in biology. And then mechanical, civil engineering, and psychology. Top 5. What other questions, comments, concerns for this now 7 stalwarts that have shown up to class? I'll remember this next time, though. Do not send an email saying class might be canceled if I get out of my meeting late. Okay, so I'm going to cover off some of the balance of dividend policy, the stuff that's critical for you to know. We've talked crap, it's already Monday. Okay, we talked last week about signaling and about how signaling and clientele effect, essentially you attract certain types of investors. Clientele effect, we talked about the widows and orphans, the AT&T stock or utility stock, where you have steady dividends and folks rely on it for regular cash flow and earnings. And then you've got another situation where you may have people who want long-term investment. They know a particular industry, and so they attack that type of clientele. There's a free cash flow hypothesis on dividend policy, which essentially says firms that can pay dividends from cash flows that can't be reinvested in positive net present value projects have higher values than firms that retain free cash flows. So essentially what this says,
Your voice speak. Sorry, it's my watch.
Does it trigger with like free cash flow? Because that would be really cool.
It's my like I push the button down. It's to Siri and she should get whatever.
Oh, cool. So she wanted to define free cash flow for us. So what you end up with is this hypothesis says, look, firms that pay dividends because they can't reinvest it profitably are going to have a higher value than firms that retain those dividends, that retain that cash, because you as the investor are going to go, hey, I would rather have that money to reinvest somewhere else and be able to choose on my own than to be forced into it by the company, and the company retaining those cash flows and actually destroying economic value. I tend to buy into this hypothesis. I think it's borne out by research. The challenge is, again, you go back to none of these stand on their own. So you then go, okay, well, what happens if they start getting positive net present value projects, they begin to lower the dividend and retain cash? The signal for that is, okay, we're not doing well. And we talked a little bit about that last class. So you really need to, as opposed to signal, you really need to be able to state as management, if you're following an alternative hypothesis other than signaling, which tends to be the dominant hypothesis, here's a policy that we're following with dividend. And in some cases, dividends will go up and dividends will go down. And when they're going up, that's not necessarily a good thing. And when they're going down, that's not necessarily a bad thing. In practice, you've got essentially the bottom one is what you tend to see, which is a stable, predictable dividend policy. Annual dividend payments remain constant or increases at a constant rate. Even if it doesn't make sense for the company to do it that way, the company does it that way because it becomes predictable. It attracts the clientele that they're looking for when you go back to that clientele effect. and it signals stability. It signals that the company is, kind of steady, moving right along, even if underlying the dividend, there's a lot of volatility. The residual dividend policy essentially says we're going to pay out whatever's left after we use all of the cash available for positive net present value projects. And this is not really followed in practice. Because at the end of the day, most of the market views signaling as kind of the predominant methodology. And so they tend to look at those things and go, okay, if there's not any excess cash, that's a problem. Constant payout ratio. There's companies that have dividends that are on a constant payout ratio where they essentially say we're paying out a certain percentage of our earnings, or they're pass-through entities. So real estate investment trusts and some other types of trust assets where they're required to pay out 93% of all their earnings every year. So their dividends go up and down. And it's set by tax law in many cases, and it's not normally 40%. Where you tend to see this in practice is real estate investment trusts or oil trusts, where they're selling various and sundry components of or interest in a pass-through entity. And so they go, okay, we got to pay out 93% by tax law in order to be able to keep this pass-through entity and not be taxed at that level. And so their dividends would go up and down. And then low regular dividend plus extras. This was a Microsoft way of doing things where they would pay out 10 or 15 cents a quarter. And then 10 years ago, they paid out $20 a share. So they build up a big cash reserve, and then they go, oh, we've got a bunch of extra cash. We're going to distribute that in terms of a special $20 a share to every shareholder. And that becomes a policy by which they go, we're going to kind of hold some cash reserves in the event that we see volatility, or to reinvest when there's good opportunities. And periodically, when we don't see good opportunities, or when we're kind of sitting fat city, or somebody's going to be going, okay, we've got a situation where they're holding too much cash and the stockholders start getting restless, they then pay out a large dividend. And here's an example. You got year 1, 2, 3, 4, and 5. You can see the net income here is pretty volatile, ranges from 800,000 to 150,000, which indicates what? A relatively high level of what? Financial or operating leverage, or total leverage, most likely. They've got a capital budget which is relatively flat. They've got 250,000 shares outstanding. They've got a payout ratio of 60%. So they've got a low regular dividend of 75 cents per share, and then they pay out, if it's over $400,000 of net income, they pay out an additional 40% of the amount over $40,000 or $400,000. So in this particular case, the net income, they got the capital budget, they got a total dividend, they pay out 80 cents. It's a residual dividend. In year 2, they actually are $50,000 short, so they pay no dividend. In year 3, which was their fat city year, they made $800,000. They pay the capital budget out. They have $600,000. They pay out $1.39, and then the last year they had $10,000 available. They paid 75 cents. So again, you've got a situation where even in the last period, because they said, okay, as long as we have excess cash flow, we're going to pay out at least 75 cents on the dollar. In this particular case, because they didn't have any excess cash flow, they paid nothing. Stable dividend would be we're paying $1 a share. Every year we're going to pay $1 a share, regardless of how much we make. Constant payout ratio. Essentially, they say we're going to pay out 60% of the net income. Our total dividend becomes this times the constant payout ratio. So they pay a dividend per share ranging from $1.20 down to 36 cents. Challenge with this, by the way, is you're going to run out of cash in the bad years because you have a capital budget, which, if you recall, comes after the net income line. So you've got to call on cash outside of the dividend. And And here's the dividend plus extras. So you've got the net income, the low regular dividend is 75 cents. Then if it's above 400,000 or $400,000, they pay an extra 40%. So you've got a total dividend kind of running across. So you got a minimum of 75 cents in year 2 and year 4. In these other 2 years, you end up with a bonus associated with the fact that the net income was over $400,000. So if you're an investor and you're reliant on these dividends to actually pay your bills, to meet your obligations, you're going to tend to look towards stable dividends as being more attractive. So when you think about the clientele effect, the clientele for a stock that's a regular dividend payer, they're looking for stable cash flow. They're relying on it to supplement their operating expenses or their pension or something along those lines. So they want stable cash flow. You can see in the residual, it could be very volatile, ranging from 0 to 4 cents all the way up to $2.40. And the low regular plus is kind of a mix of the two, where you know you're going to get 75 cents every period, but if there's a really good year, it's going to pop up. The dividend policy matters because, again, there's both a clientele and a signal for these that say, hey, this is stable, the company's doing fine. They're going to attract a certain type of investor that's looking for stable cash flows. These others, and low regular plus tends to attracts similar clientele to stable, but essentially you're stable at 75 and you got bonuses. Yes, sir.
And this is already built into the stock price.
Yes. So that's a great great question. Well, how is it built into the stock price?
It's it has a lower risk. It's viewed as less risky, so it costs less.
And how is the stock price determined? What's the two components of the stock price?
The perceived future cash flow discounted by risk.
Yes, and what's the perceived future cash flows on common stock? Dividends. So what you've got is essentially the dividends are factored in because that's what you're looking at is the expected future cash flows. And then the volatility of those cash flows is reflected in the risk. And so you're looking at not only the volatility of these cash flows, but the volatility of the underlying operations, business risk associated with the methodology by which these cash flows are paid out. So this could potentially be the lower risk payout methodology, but it's got more volatility and the expected future cash flows are going to be less certain from the shareholder's perspective than stable, where you may have a higher risk associated with it because the company has a perceived obligation, though not a legal one, to pay out $1 a share, but you can better model the expected future cash flows down the road. And so you're absolutely right. It is factored in the stock price, and you just hit on the two ways that it is. There you go. Because it's finance, and it's just got those two pieces. So whenever you see that kind of question, you know darn well that it's going to be, if you have a question on any finance thing, throughout risk, cash flow, risk, cash flow, risk, cash flow, expected future cash flow, present value. Those are cool buzzwords, but it's really what finance is. What are the expected future cash flows? What's the risk associated to it? That's the discount rate. Factor in the two, and that's your present value, and that's your value of any financial asset. I say it every class. And so it's factored in here through the payout rate on the dividend. Dividend payments in practice. You've got a declaration date, at which point the dividend is declared. And we talked about this early in the semester. At which point the dividend is declared, it becomes a liability. So now it's been declared by the board's voted on, it becomes liability. It's difficult to undeclare a dividend. You can do it. If it's going to force a company into bankruptcy, you may be forced to do it. But you've got a declaration date, which is essentially the date that the board goes, we're going to pay this dividend on a certain date through board action. So essentially the board would vote to take it back. There's a holder of record date. The holder of record date is the date at which if you own that stock, you're going to receive the dividend. also called in some cases the ex-dividend date. So you'll see more often than not in things like the Wall Street Journal, there's these little, if you look at quotes on the Wall Street Journal, which I don't know if anybody ever uses paper anymore for quotes, there'll be an X next to a stock when it goes ex-dividend, which essentially means up until that date, the board declares a date. And the board says, if the board said on March 31st, we're declaring a dividend for the first quarter payable to shareholders of record on April 15th, and it will be paid on April 30th, which is a pretty typical thing. From March 31st until April 15th, the stock trades with dividend, which means if you buy or sell that stock from April 5th or from March 31st to April 15th, you get that dividend. If you sell the stock on April 17th, the holder of record on April 15th, the person who sold the stock gets the dividend. And the stock trades ex-dividend without dividend after the 15th of April through to the 30th of April when the dividend is actually paid. So the holder record date is the person who gets the dividend. If you hold the stock on that date, you get it. You can sell it afterwards, and even if it hasn't been paid yet, you're going to get the dividend. They're going to mail it to your house. Ex-dividend date, the date on which a right to the next dividend no longer accompanies a stock, generally 2 business days prior to the holder of record date, and a payment date, the date on which the company actually pays the dividend, either by paper or electronic check. Some companies still pay dividends by check. I get a check from KeyBank every quarter. Why they won't send it to my bank, I don't know, since they're a bank. But some still send checks. Others will do ACH deposit. Others do dividend reinvestment, where essentially you go, I don't want the stock, or I don't want the cash, reinvest it in more stock. So they end up buying stock on the open market, you reinvest it, and you get more stock. It's essentially compounds your stock at the dividend rate. Thus, the dividend reinvestment plan. These are plans, and if you guys are interested in investing in stocks that pay dividends, and you want to invest directly, there's direct investment plans that normally accompany dividend reinvestment plans. So if you go, hey, I want to invest in US Bank. I think US Bank is a cool company. You can go to your broker, Charles Schwab. You can pay $50, $75, $100. They can execute a trade to buy you 100 shares of US Bank at $40 a share, $4,000 plus $100 commission. Or you can log on to US Bank's website and say, I want to buy 100 shares of US Bank. As long as you reinvest the dividends, you can do it for free or near free. So there's dividend reinvestment plans, which essentially say when the dividends are paid, instead of sending you a check, we reinvest it in more stock of the company. And you can usually in a dividend reinvestment plan, you can go contact the company directly, normally on their website, and make a direct investment of that stock without having to go through a broker. And you normally can sell directly without having to go through a broker. And so you generally get a significant discount to trade in those stocks, and you can do it directly with the company or with the company's transfer agent, as opposed to having to work through Charles Schwab or TD Ameritrade or whoever. So dividend reinvestment plans, if you're a company that routinely has or pays dividends, these are pretty attractive because, for instance, if you're a person who isn't quite ready for retirement, so you might be coming out of college, you're in your mid-20s and you go, okay, I'm going to invest in US Bank. I'm going to put $5,000 in, I'm going to have it reinvest. For the next 40 years, it just grows and grows and grows and grows and grows. And then you turn off the dividend reinvestment when you turn 62 and they start sending you a check every quarter. So I'll give a little story about dividend reinvestment plans. My father, many, many, many years ago, he's long since deceased, but many, many years ago, back in the 70s, he set up these dividend reinvestment plans. And what he did was he said, okay, I'm going to invest in utilities. And I'm going to get a utility that pays its dividend in January, and then in April, and and then in July, and then in October, and then I'm gonna get one that pays in February, et cetera, et cetera, et cetera. So every month, a utility would be paying a quarterly dividend. And then he just put equal amounts into each utility and had it reinvest for years. Boom, 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 boom. When he retired at 58, 59, he turned off the dividend reinvestment, and on top of his Army pension and on top of his IBM pension, he managed to get a check every month from one of these utilities that was pushing $1,000 each month, just because he let the reinvestment plan work. So it was like a little quasi pension that he had set up for himself. And it's easy for you or anybody else to do it because the cost is almost zero, and you can set it, and companies don't always pay on, on the beginning of or the end of a quarter, and you can set something up to be able to build that pension for yourself. There's a few factors that impact dividend policy. Covenants, debt covenants. So, Chris asked, how do you undo an issuance of a dividend? Well, if you trip a debt covenant, the bank's going to make you undo it. And so it's going to say you can't issue a dividend if you aren't hitting certain cash flow requirements. So if you declare one and then you find out subsequently you didn't meet those covenant restrictions, you'll have to reverse it. You can't exceed retained earnings. You can't run negative retained earnings and issue dividends. Otherwise, it's return of capital of your par value. You can't pay dividends in excess of your cash availability. So if you only have $10,000, you got to pay $250,000 of dividends, you can't do it. So cash availability is going to impact your ability to pay dividends. And the IRS will not allow you to accumulate retained earnings in excess. And here's why. Dividends, when a company earns money, it pays taxes. Then when it pays out dividends, the person receiving the dividend pays taxes. So the IRS doesn't want companies to go, okay, we're just going to accumulate all this money in cash forever, because they don't get the second bite of the apple. They don't get to tax the guy receiving or gal receiving the dividend. And so the IRS says, look, you've got to show us that you have a purpose for retaining this excess cash, for accumulating all this dividend money. Otherwise, we're going to get an excise tax on your accumulated capital, because we want you to pay it out as dividends, so that way when Jason gets his dividend check, he has to pay tax on it too. So it gets taxed once at the corporate level and once at the dividend recipient's level. That's called double taxation, which is one of the drawbacks for a C corporation. Any questions? It's been fun. It's been real. It's been real fun. I will see you all on Wednesday. Have a good evening.